Hey, what's up, everybody? Good morning. It is Saturday. Hope you are up enjoying the day. And this is Multifamily Unplugged. I am glad that you're here today. And buckle up because you're going to be in for a ride today. Have a little bit of a twist on what we're going to talk about, but we'll get to that in a minute. Let me ask you, are you being intentional? Are you being intentional about what you're trying to accomplish today, this weekend, in your life in general? Are you investing in yourself? Are you investing in your future? I always talk about how if you invest in yourself, whether it's a seminar, whether it's reading a book, whether it's listening to a podcast or getting some coaching, investing in yourself to grow personally. The more we grow personally, the more we're going to grow professionally. And I think we all need to be intentional about that. Hey, I've had a coach in my life for 20 years and I still invest in myself today because it helps me to grow professionally in my business. And it helps me to be able to bring better guests, better content, more information relevant to today's market, today's world. And my guest today, I know that we're going to talk a little bit about that. But if you're new to the show, I'm glad that you're here today. Please like us, love us, smash the subscribe button if you're out on YouTube. Help attract some other people for us because we are always bringing on a daily basis new relevant content, little tips, little suggestions that are going to help you grow your business. And isn't that why you're here, right? You want knowledge, you want information, you want to be able to grow your business a little bit. And that's what I want to bring to you. So, hey, this morning I am joined by Brock Vandenberg. Brock is a friend of mine that I met a while back through a longtime friend of mine. And Brock's with Telemar Financial. He runs the Telemar Income Fund One. We're going to talk about that. He's from beautiful Southern California, San Diego. And his history is he worked for the FDIC back closing the banks down. So that will be kind of interesting as we get into this morning. But hey, Brock, how's it going?
Mike, great. Thanks for including me on the podcast.
Yeah, I appreciate it. And we kind of caught you off guard this morning because you thought you got here via a different way than you got here. So
yes, and so I'm excited to be here today, and I'm excited to share my story and answer some questions.
Yeah, it's kind of like going to a surprise party for your birthday, right?
Well, I'll tell you what, going to this or just generally what's going on in the economy or in the real estate industry seems like a surprise party every single day.
Yeah, right. Hey, so I always start, and kick this off with a famous question, and that's one word, what best describes you personally and professionally?
We were talking about this and I was thinking of it, and it's persistence. Okay. So, when I talk to real estate investors, especially young real estate investors that are just getting into the industry, there's this perception, and especially what you see everywhere, is that people are getting rich quickly. Making money immediately, like as if success is going to be within their first year, and it really isn't the case. And it takes a lot, as you know, it takes time to learn your craft, to build your network, to find out what you love to do, and then build upon it. And you got to be persistent. I've been at this, what I'm doing, for over 20 years. And so, and I'm just starting, you're always learning something new. And so it takes time. So persistence.
Yeah. So let me ask you this, that persistence, do you think that that's something that you innately were born with, or do you think that was something you learned? Where'd that come from?
That's a good question. I wouldn't say that I was not saying I was not persistent, but I seem to always think that success was going to be pretty quick, right? And get talking to the right people. If you're going to make it pretty quick in the industry, and I got lucky. I had early on, I had some people that I could look up to and kind of show me the way of being successful. Read some books that gave me some insight into the success of investing in real estate. Even prior to investing or being in real estate, I was in the tech industry, and it really wasn't kind of the passion that I had. But when I got involved in real estate, I knew exactly that is what I wanted to do. I just didn't know how I wanted to be involved. And then I was able to kind of narrow it down to real estate finance and get early on, pick up a couple of mentors that really kind of showed me the way, and I've been there the whole time as a mentor.
Yeah. And what do you think, if you just talk about the mentor thing for a minute, what do you think they've meant to where you're at today?
So I think as a mentor, kind of giving you an idea of where the big picture is, especially in real estate finance, what is it, how or do things work? And not, as much as the industry changes, the dynamics of the industry changes, the big picture really doesn't change. So I got lucky. So when I first in real estate, when I got involved in real estate, I worked for a private equity fund, and really their focus at the time was to invest in residential development projects as kind of almost like a limited partner. They're more of a we'll call mezz debt, so second position behind a construction loan. So they would step in and develop out large projects. And it was such a great opportunity. I was put behind a computer screen on Excel and ran cash flows literally for 2-3 years on projects. And I hundreds of projects did I underwrite. And you start to learn a lot. And then then you're out there, kicking the dirt, looking at these projects. And unfortunately, but fortunately, 2008 hit, and I'd started in about 2001, and I was growing with the company. There was a lot of opportunity for me, and then one day, it all came crashing down. They decided that this wasn't a strategy they wanted to do anymore, and literally, I was a real estate banker out on the street, and there were no job prospects for a real estate banker at that point.
Yeah,
and so. But yeah, so that's kind of, but my mentor who ran the company had always stayed in touch with me and guided me and provided me some really insight as to kind of what I should be focusing on.
Yeah, interesting. Hey, you talk about those spreadsheets and looking at numbers. Our buddy Forrest always says the math never lies.
And I learned that more and more. So in the industry as a private lender, you just it's just mathematics. At the end of the day, you're looking at certain statistics, and you'll see it. Oh, we've done it for so long now. If something is off, there's a likelihood that the loan isn't going to perform if this one piece statistic is off.
Yeah.
So he's right. Forrest is very, very keen on that.
Yeah. And here's what's interesting. I love that you said statistics, because I think it goes beyond just the asset, right? Mm-hmm. I mean, the asset could perform, but if the market that asset's in isn't a performing market, and I think that can be even more important in today's environment than any other environment, because, hey, look, I know there's assets and markets out there that are not performing, but then there's assets and markets that are performing or emerging, and I think that, they're different. Those are different things that we all need to look at too, as a real estate investor, multifamily investor, however, your makeup is in this business.
No, that's a good point. And one of the things my mentor told, so I'm on the finance side. I don't go out and buy a lot of real estate. I look at it from a private lending standpoint is understanding the exit strategy of your loan. And kind of the same idea of, you're buying a multifamily property is, look, what's the long-term goal? Okay. But if something occurs, what alternative strategy do I have to bring the asset, to make the asset perform? Yeah. And especially today, in today's market, I have to imagine in the multifamily industry, my colleagues that are in the multifamily industry are having to make decisions based upon where interest rates are from just a year ago and how that impacts the exit strategy they had when they bought the property originally.
So let's talk about your background a little bit. How'd you get into the world of real estate? But then, I mentioned early on, you worked for the FDIC, talk about all that a little bit.
So it's funny. So I was in the tech industry during the tech boom up in the Bay Area. It was a great opportunity. Love to see kind of the rage. This was even before Amazon or anything. If you remember that, pets.com, everything was .com back then. And so I really had an opportunity to kind of see the tech industry, but it wasn't a passion that I had. Picked up a book I think we've all heard it. It was a Rich Dad, Poor Dad book.
Wow.
And Kiyosaki was sitting there and talking about what was, number one, owning real estate, investing in real estate, and really owning your own business to do it long term. And I don't know, it just clicked for me. I'm like, that is what I want to do. And so I went out and actually ended up started buying up some of my own properties when I up in the Bay Area. Actually, still hold them too. And then met my wife, my now wife, and moved back down to San Diego. Luckily, someone took a chance. I had read a couple books on real estate finance. I took some accounting courses and got at the bottom level of the private equity fund we were talking about. And they literally just stuck me behind a computer and was just doing cash flow. I mean, most not basic, but boring work you can think of. And but it was such a great opportunity. And we talked about kind of what what occurred. But as the market adjusted, and I went back, I had an opportunity to take a 2-year term position with the FDIC. And again, it's just funny how stars kind of aligned. I call it the white collar prison for real estate bankers, because we unwound everything that we created. So I would be shipped off to a bank. It would be a Wednesday afternoon. They would say, Brock, you are going to go to Arkansas and we are going to shut this bank down. It's not performing. Your responsibility with your team is to go and underwrite all the loans, give us a value of those loans, and then assist us in selling those loans to the open market. The FDIC would step in on the bank, typically just hand that bank over the depositors to another assuming bank. So the depositor funds were always okay. It was just they needed to carve out in most cases some of those bad loans. And so so I spent 2 years on the road looking at loan files, underwriting loans, and then packaging them up and selling them off to private investors. And it's just funny how I from spreadsheets to underwriting loans got me to where I am today.
So how does that market, when you were doing that, compare to today's market? Are we looking at?
Yeah, very. I mean, the dynamics of what's going on in the market are so different. And the biggest difference right now, obviously, are the banks were lending under standards that resulted in a massive amount of foreclosures. Completely different from today. I mean, banks have been very stringent on the guidelines that they're lending, but what happened because of that created a whole cottage industry for the private lending industry, where banks would have been funding loans that my company and others would be funding are no longer funding. And so this opened this opportunity for private lenders. Bloomberg had a recent article, and I thought it was kind of funny. They called us shadow lenders. So they said, oh, these shadow lenders are coming out of the dark alleys of lending on real estate. I mean, we've been here for the beginning of time. We're doing no different. We're no different than any other bank lending money out. It's just a different platform of which it occurs. But the industry has exploded. And now, and I kind of jump ahead here with the recent closures and that's why I brought up the FDIC with you, when they went in and shut down Silicon Valley Bank, Signature Bank, and others. Not only do I know some of the guys that were involved with that, but it further opened up the opportunity, because banks right now do not want to lend. They need to create liquidity on their balance sheet. And so they've really pulled back the lending that they're doing, create that liquidity on their balance sheet, which has opened up, again, a bigger market for the private lending industry.
So obviously, in order to do that, it's a function of capital, and you have to go get capital somewhere. Yeah. If banks aren't lending, where does your capital come from?
So we assist high net worth investors, family offices, pension plans that want to get involved in this type of investment. At the end of the day, what we're doing, we're acting as the bank, lending money to real estate investors. Majority of these people are buying up single family or multifamily properties to renovate them and then sell them for a profit. The other 50% of our business is just bridge loans. So maybe somebody is buying a service center. For example, we just did an automotive service center, and the bank was supposed to go in and close the loan, but they couldn't. And so they went out to the private lending market. The mortgage broker came to us, and we funded a bridge loan for them, giving them the time to close on the property and then get more conventional financing in place. And so that is our target market, and the investors that are coming in want to take advantage of the returns that you can now get in this market. Mike, we were also talking about a lot of the investors that want to get involved in real estate but don't want to own property, don't want to manage tenants, don't want to go locate properties. This is an alternative option for them to earn consistent monthly cash flow, get some of the tax advantages of owning real estate, and get involved and engaged and take advantage of this opportunity now without really having to, again, own a portfolio of real estate.
Yeah. And it's interesting because we call that passive investing, right? Mm-hmm. And that's that limited partner that comes in and partners alongside of us in our syndication business when we're doing a multifamily deal. It's the same philosophy in your space where those limited partners have the ability to invest, and you're the guy who looks at the other deals out there to invest in.
Yep.
And it's funny because I talked to an investor yesterday, or potential investor, and he says, well, I'm trying to decide whether I should do this myself or if I should, just invest my money with you or another type of entity.
Yeah.
I said, let me ask you a question. I said, you sold 75 houses last year. You made, $500,000. I said, you have to keep your foot on the gas to do that, right? Mm-hmm. He said, yeah. I said, so everything that goes into an investment opportunity. You got to find the property, underwrite the property, do the due diligence, do the construction, do the financing, manage the whole thing. How much time is that going to take away from your day job?
Yeah.
Are you ready to skyrocket your investment portfolio and leave a legacy? Are you tired of inconsistent returns received in the stock market? Then it's time you take a look at alternative investment options like a passive investment in multifamily real estate. No tenants, trash, or toilets. Just a solid return on an annual investment, including quarterly returns along the way. These lower risk and secure assets are also a great hedge against inflation. If you want to hear more about these types of opportunities, email me directly to schedule a 15-minute consultation to see if you qualify. You can email me at mike@mycoreintentions.com.
Where you're making $500,000 a year and you're going to get caught up in this. Wouldn't it make more sense just to add to what you already have in place and keep your foot on the gas?
Yeah.
I think that a lot of times people think that, there's that saying, right? It's always grass is greener on the other side. But when you have all of this work that you do yourself for them, doesn't it make more sense for people to invest in a fund like yours?
And Mike, you bring up a great point, because I educate, and you do as well on this podcast, of how people can get involved in the multifamily sector, invest in it on their own. Go out and you hear the tips, and I'm an open book. I'll tell everybody the strategy that I use in lending. But at the end of the day, you're right. And I think one point that's also very important to note is we typically will find the better deals. We're more networked. We've been doing it for a longer period of time. So, if you go out and you want to do it yourself, you got to just, number one, build your network to find the opportunities. That's just step one. Then step two is execute on whatever strategy you decide to use. So I tell that to investors that what we call trust deed investing. So investors that do one-off loans, they may lend money themselves to a real estate investor. But you're right. Do they have the time to find it, to identify the loan, to manage the loan, to, if something were to go bad, do you have the background to get yourself out of that position?
Yeah. So let's talk about the market a little bit before we get it, and too granular into your fund and what you're doing. Talk about the market. You got a banking background. You've been in numbers for a long time. where the hell are we headed?
I can't prognosticate as to where we're going to go into a recession or not, because again, this is something I've learned. Like, look, I don't know. All I can tell you is, or I can say is that I am comfortable and confident that the markets that at least I lend in are going to perform well over the long term. And I can look at historic numbers. So 80% of our portfolio is located just here in San Diego. Do I think 10 years from now, a single family home in San Diego is going to be worth more in 10 years than it is today? I'll take that bet. That's how I look at it. Now, in the meantime, yes, there could be some turbulence, some volatility in the market. I mean, we've seen it. We saw COVID. We've seen the closure of banks. We've seen the rise of interest rates. But if you still look at if you were to look at single family houses in most markets, they performed well. They've been extremely resilient. And I can't say this on behalf of all markets, but I can say in San Diego and some of other markets that I would suggest investing in, is that the supply constraints that we have buffer you from that volatility, so you can hold out and not be massively negatively impacted by something that happens geopolitically or economically.
Why San Diego over Chicago?
Well, number one,
an easy one, but
well, I like to invest in my backyard. That's another thing that I talk about. Is like, look in your backyard. I'm not saying, look, if you have to scale, absolutely, you're going to look outside of markets that you can generally drive to, but there's enough demand for what I offer in San Diego alone that we're confident just really focused in San Diego and really just Southern California.
Yeah. So what's interesting to me is knowing what home prices are in your market, and that there's a fix and flip market there.
Yeah.
Right. I mean, and that just goes to show you that there's business everywhere. You just uncover enough rocks, right?
Yep.
And open enough doors, and you'll find those opportunities and find that right opportunity. So
hold on. Well, consider this. This is, you talk about difficulty in finding opportunities. Obviously, everybody has difficulty finding opportunity. But if you were to look at the San Diego, the multiple listing service right now, the MLS, they have 1,500 homes listed for sale right now in San Diego for a population of a little over 2 million people. It's legit. Literally zero homes are available. And so when talk about like, how do you get comfortable in the market that you're focused on? That number, I mean, just not enough housing. Yeah. And then you talk about flipping even in San Diego, like how is that even a market? Well, they've layered in now, and we can get in this, accessory dwelling units, ADU units.
Yeah.
And that has just opened up a whole nother market for, we call it flippers, but real estate investors.
Are you loaning on ADUs, on the construction of ADUs?
So it's interesting because, again, this is the problem that a lot of markets have, is that an investor can buy a property, but it's going to take them 9 to 12 months just to get the permits to build the ADU. So they need the short-term financing to simply close on the land or the house, the property. Then they have to follow up with another loan just to get the financing to build out those ADUs. And then the final loan, if they want to hold on to the property as a long-term rental, get some longer-term financing for that project. So that's a big market here in a lot of coastal markets like San Diego, again, LA, the Bay Area.
Yeah, I have a good friend up in Long Beach who, is just on ADUs, and be a good connection for you. We'll talk about that later.
Yeah. But it kind of leads into what exactly you're doing, which is investing in the multifamily sector. ADUs are no different than just investing in multifamily. That's right. What you're doing.
Right. Exactly. You're adding it, really. Yeah. So, hey, let's talk about your fund. Okay. Telemar Income Fund 1. Now, somebody would think, wow, Fund 1, this is your first fund, but it's not. You've been doing this a while. So talk about how you got there and what you're doing.
Yeah. So after I had the opportunity to be with the FDIC over 2 years, I started to lend money myself out to real estate investors. These were people that were buying houses at foreclosure sales or from the banks, and there was absolutely no financing available for these investors. So I started lending my money out. Didn't really understand there was an industry behind it. Had some very good success doing it. Some other investors wanted to invest with me, so I started to allow investors to invest in individual notes. So somebody comes to me with one loan, and then I would place investor capital into that loan. And I was able to build a business around it. So we got up to about 60 million in loans outstanding in the Southern California market. And that was probably about 300 some odd investors. And it just got too big. There were too many investors on too many individual loans, and it was unwieldy. And so I looked at a better strategy that I could help my investor clients invest in this sector a little better. And that was simply to pool their capital into an individual fund. So by that time, we'd already funded, again, 350 million. We had 60 million outstanding. And I, after some discussions with investors, said, look, this is a better strategy because number one, you're not jumping in between loans. Number two, it's more diversified. So we're building a portfolio of loans that you invest in. And then number three, there's some significant, the way we structured it as a real estate investment trust, there's some significant tax advantages. So for example, like the 20% tax deduction. So any distribution that's paid out of our fund qualifies for that 20% tax deduction. And a lot of my investors said, okay, that's definitely a better platform than what we're doing. And for me, it was able to scale the business bigger. So we were able to do more loans more efficiently.
Do you only take accredited investors into your fund, or do you take non-accreds also?
So we're a Reg D fully accredited fund.
Okay.
So the prototypical investor for me is probably either someone that's nearing retirement or in retirement that's looking for consistent monthly income. Again, that likes that tax advantages. Average investor probably is around 250,000 invested, but we have a minimum investment of 50,000 for people that want to just get started.
And what kind of return can people see on that?
Oh yeah, so I just had a conversation with a potential investor on this one. So when we formed the fund back in 2021, our target yield was 7.25%. Now remember, the Fed funds rate was near zero. I think it was at 0.25%. So we were happy to get a 7.25% return. That changed. So about May timeframe of 2022 is when the Fed started stepping in and increasing rates. So what that did, it was directly impact what we were charging borrowers for our capital. So from 7%, so now our target yield is at 9%. So all secured on first trust deeds. And it's starting to make very attractive returns to be in this market. I said Bloomberg had a great article about the shadow lending industry. BlackRock was just being interviewed today on CNBC, the CEO, and he was talking about the opportunity in the private lending market. And he immediately went to the fact that banks were really pulling back on the financing and that they were investing heavily into this sector.
Yeah. So, what's interesting is when you talk about the private lending sector, you and I really do the same thing. We're just in a couple different asset classes. And so I want people to understand that, especially somebody who might be sitting on the sidelines going, well, Grant Cardone is saying the world's coming to an end, and, all the banks are closing down and interest rates are so high.
Yeah.
I think all that noise affects the judgment of our client. And yours and my client really is the limited partner, the people that invest alongside of us that see a return from our efforts.
Yep.
So what do you tell people today to get them over all the doomsday experts out there that are saying what they're saying?
Mike, you brought up a really good point, is noise. And I've been saying that's why I use that term, because there's so much noise out there in the market that, you could just be stuck and not do anything. You could I would almost say you just leave your money in the bank, but you don't even want to leave your money in the bank anymore. Yeah. But it really isn't the case. Obviously as an investor, you need to look at where the opportunity is. I think absolutely there's opportunity in the multifamily sector, definitely an opportunity in the private lending sector. It's just depending upon like how you want to invest. One of the advantages I talk about investing in the private lending, especially our fund, is that there's no lockup period. So, you can invest, and if you don't feel confident with the investment or you want to increase or decrease your investment, you can get it out a little quicker. So there's more liquidity in I think the debt market than holding an asset longer term. But then again, there's some disadvantages on that as well.
Yeah, and I want people to understand that, right? Because a lot of my listeners, if they're not new this morning, know that I syndicate multifamily, and it's less liquid than what you do. What you do is you offer some liquidity. So if somebody's looking for a short-term position where they're waiting for something else in their life to happen, but they want to park some capital, you have a great resource for that.
Yep, absolutely.
Hey, I just talked to somebody who said, well, I need to invest in hard asset, brick and mortar, because when the dollar goes to zero, I'm going to be protected.
Yeah.
What's your thought around that?
Well, I don't know if the dollar is going to go to zero. I guess I don't invest using that methodology. Yeah. But yeah, I mean, obviously owning hard assets, can buffer you against, inflationary factors. So that, that's one of the advantages of owning the physical asset or owning real estate. One of the things I talk about that, because people ask, well, Brock, I'm investing in this mortgage fund, what if rates go up? Well, that's really like an advantage for us. So, as rates go up, we just increase the borrowing cost to our borrowers, which again directly positively impacts the returns to the investor. So that's a positive impact. Now, I get kind of into the weeds here because there's a lot of investors that will invest in, again, individual trust deeds. So these are individual loans. And the hurdle they have when investing in individual loans is that, yes, when rates go up, you're stuck in that loan until it pays off. And then when you reinvest, you can get a little higher return. But unless you structure the loan as some type of variable rate loan, you're stuck in that loan for however long it is.
Yeah.
And that's for people that invest, that want to move to a mortgage fund structure to invest in. That's one of the advantages.
Yeah. Interesting. I think we'll see some deals come on the market, and probably even in your space, because of variable rate loans. Some operators thought that they were brilliant because they got a floating rate debt at 2%, and now all of a sudden they're 10, and they're like, oh no. So
no, I think that, and that's again, every investment, every industry, has to deal with some type of hurdles out there. The private lending industry, you want to make sure that you're lending and that you're securing your loans on assets in good areas with good operators. We're not in the business. I think there's this idea that private lenders are in the business to loan to own. We look at it more like a bank. We do not want a non-performing loan. It is very time consuming and takes a lot of energy to deal with a non-performing loan. So that's not what we're looking to do. We want to have a very healthy balance sheet.
Yeah. I find your world is a little interesting because you really have two customers. Mm-hmm. You have the investor, and then you have the borrower.
Yeah.
I always found that kind of business is interesting because you're dealing with two customers.
Yeah.
And in my space, I have one client, right? That's my private investor. And that's where, I have to answer to them and make sure that their profit is there. But you have two. So how does that work in your world?
So I equate it to being a bank, right? I mean, at the end of the day, that really is kind of how we're structured. So I tell my investors who may not have a real deep knowledge of what we do, is I say, look, consider yourself a depositor into Talamar Income Fund. We then take your funds and lend it out. Instead of earning zero on your deposits at a bank, you can actually earn a decent monthly cash flow on the money you deposit. that money you deposited is lent out and secured on real estate throughout the Southern California market, just as a bank would do with your checking funds.
Interesting. How much are you raising in your fund?
So yeah, well, I mean, it's interesting. So we came out of the gate. We had a lot of investors that we had already. So within the first probably 6 months, we had about 10 million.
Okay.
But since May of 2021, we've raised a little over 40 million for the fund, and our goal for the year end is at 75 million.
Okay. All right, great. So you are 2/3 of the way there?
Yeah, we're getting there. And there's, how it is, Mike, raising money and a lot of conversations, a lot of follow-up, a lot of explanations of what we're doing. And but it's been, I got to tell you, I go back to the term of persistent, right? You just got to be persistent. And, just again, it's educating your customer, both on the lending side and then also obviously on the borrowing side of what you're doing. But a lot of educating, this is what we're doing. This is why the opportunity exists. And then showing them the stats of why it exists. And it's been a good ride. I've really enjoyed making that transition and been, raising money for this fund.
Yeah. Interesting. Hey, your word was persistent. Mine's always been tenacious. Kind of the same thing, right?
Yeah.
So I have a lot of people that listen in who are who raise capital, right?
Okay.
Talk about a couple of the techniques that you use through your company and to attract investors to start those conversations with investors.
Yeah, so I would say that like our number one strategy is literally social media. So going on and kind of explaining and educating people on what I do. I mean, I'm an open book. I'll tell everybody the strategies that I use to lending money. So, my focus is, loan sizes, X amount, credit scores are this, markets are this. I'm an open book, and they can use that strategy to go out and do it themselves. I would say though that most people would say, okay, Brock, it sounds interesting. I get it, but I'd rather have a professional manage my money and allow me. And we were talking about this earlier, Mike, is focus on what I do. Maybe they own their own business, or they're doing something that they want to focus on, and so they just want to get invested in this investment, which the mortgage fund allows them to do.
Yeah.
So that would be the number one, is just social media education, and then it's amazing because in my operations person actually pointed this out, because we were looking at who was our prototypical investor, where are they coming from, and we looked through age and income and all that. But the one thing that stuck out, which I was blown away with, was they were or currently in the banking industry, so they had a background of banking, or they were in real estate. So but both of them were not confident in investing in the stock market. They did not like the volatility. They wanted something that was a little more predictable, more cash flow, and on something they understood.
Did you get granular on those statistics? Like they're currently in real estate, from what capacity?
So yeah, we talked about banking. We talked about they're operators and owned real estate, right? And so they wanted to move some of the money into maybe the financing side. But like if you were to age group, I mean, I can tell you right away, it's 50 to 65 makes up about 70% of our portfolio, and then there's some of the older. So remember, we're an accredited investor, so we're probably not going to pick up much of the younger population just yet. What do we have? Net worth, easily probably between the 2.5. I think we had about a little over 2.5 million was net worth. Average investors around 250,000. What other things did we have? About a little over 60% were retired, which I thought was interesting. And then people you probably had, I look at, who are the people that have 10 million or greater? And that made up about 7% of our investors in our portfolio. We have right now about 145 investors in the fund.
That's a huge number.
Yeah.
On that 10 million or greater number. Yeah, good for you. Well, and again, that comes with persistence and time, right? Continuing to stay in the game and doing it. I think so many times people fail on a deal or you know slow to come out of the starting blocks, or they keep beating the pavement and don't get anywhere and they quit. And I don't think any of us can quit. We have to stay focused and stay on track. I have an underwriter that is, he's 20 years old. He's a finance major at TCU, and he's got the vision. He's got the same vision that I had when I was 40.
Yeah.
But he's got it at 20.
That's so important to have.
Yeah. And somebody like that is going to do really well long-term in this business, but you got to stay persistent and focused and keep doing the same thing. We just underwrote $1 billion in assets, Brock, between June and January, 90 deals, $1 billion in assets between Florida, Atlanta, and Texas.
Mm-hmm.
And then we finally found a deal in Oklahoma because it came to us off market and it made sense, right? But if we'd have quit at 88 or 87 deals, there's nothing out there, we wouldn't have got to it. So it's,
you're tenacious.
Thank you.
But you bring an awesome point up, because you don't know what's going to come out of that conversation, and you don't know what's going to trigger that investor to decide to invest. As long as you're in the back of their head and saying, okay, man, who is that guy that I talked to about the mortgage fund? Oh, that was Brock. That was years ago, but maybe it's a good time right now. You need to get your message out. You need to stay focused, invest, focus on what you're good at, and just be very persistent about getting that message out, because I can tell you, it will be successful over the long term. It just takes time.
Absolutely. 100%. Great way to end. Hey, tell people, I don't know if you have a book or an ebook or something somebody can go get, but tell people how they can get a hold of you.
Yeah, so best way to reach out to me, I think my email address is on the screen here at bvandenberg@talomarfinancial.com. But you can actually go to our website, go into the drop-down menu, Investing, and you can get a copy of our executive summary. So we update it monthly of all the returns and kind of the portfolio of loans that we're currently managing, size of portfolio, returns, and all that. You can get an access to that, and be more than happy to share that with you.
Okay, awesome. Hey, I always like to end on 3 bonus questions. So,
okay, all right.
Best book you ever read?
Well, I got to say it's Rich Dad, Poor Dad, because it did get me started. There's some great leadership books out there, but Rich Dad got me started and get me in the mindset of starting a business, investing in real estate.
Okay. How about the best restaurant you've ever eaten at?
Oh, it's Roberto's. If you're in San Diego, you have to go to Roberto's. It's the best Mexican food in San Diego.
Okay.
It ain't healthy. There's nothing healthy about it, but it's a great restaurant.
Me and Forrest are coming soon. So.
Oh, well, you know what? Roberto's is a hole in the wall. I'll treat you to a little nicer of a restaurant. There's some better Mexican restaurants. Well, you got to experience Roberto's. It's an experience.
I'm in. And best tourist attraction.
Tourist attraction. Interesting. That I've gone to and enjoyed. I had an opportunity when I was young to go out to actually see Wall Street, right? The trading floor. And I was so mesmerized by the activity and everything and the energy that was going on. I always wanted to be a stockbroker. That's like kind of what all through like grade school and high school. So Wall Street, I saw it, and it was really cool.
It's a little different today than it was back then.
Yeah, I know, right? I haven't seen it, but it's just all computers now.
Yeah. Hey, thanks for being here. I appreciate it.
Hey, Mike, thank you very much for having me on.
And you definitely have a lot to offer people. So, hey, I'm going to move you to the back room. If you hang out with me for a minute, I'm just going to say goodbye.
Great. Thank you, Mike.
Yeah. Hey, everybody. That was eye-opening, huh? A little bit different, a little twist, a little different way maybe to invest, right? And to participate in real estate, participate in some real estate term or returns that can keep you a little liquid and help you get to the place that you want to go. But hey, I would highly urge you to reach out to Brock, go to his website, grab his summary so that you can see exactly how that works and see if it's a place that will help you for a while to put some capital while you're waiting maybe to do your next deal or for the environment to change or whatever you're waiting for. But thanks for being here this morning. We are here every Saturday morning bringing some content, bringing some information, helping you grow, helping you prosper. And if you're looking to invest in multifamily, give me a call. If you have questions or anything that I can do for you, don't hesitate to reach out. I'm open, love to network, look forward to talking to you soon. And everybody have a